All right, are you ready for the excitement of the next video? Welcome back, Dan Weston's channel. So number 3 now in what you can invest in your retirement account would be the 3-fund Boglehead portfolio, or I've heard of it's like the 3-fund lazy portfolio, blah, blah. I've heard it called like stuff like that. So 3-fund portfolio, shockingly, it's a Boglehead idea. Okay, so now we're getting to a Boglehead style portfolio where the first two, not so much. So basically, you're going to buy 3 specific investments. Now, it's some, and I'll show you like my options, my wife's. It's not so easy to replicate this exactly. So you will pick a Vanguard Total U.S. index, the whole U.S. market. That's the theory, low cost. Now, I don't have that. I have an S&P 500, so either or. So either the total U.S. market or S&P, whatever they offer you. Don't worry about the small and mid cap. Number 2 will be a total ex-US international index. And then the third option would be a total US bond index. That is a 3-fund portfolio. Now, the allocations, there's not set allocations. So those are the 3 core funds you'll buy for this 3-fund portfolio. How you want to split it between them depends really on yourself, your age, how many years till you're retired, how much risk are you willing to take on. There's all these factors. So this is not, the first 2 we covered are essentially set it and forget it. I mean, the first one, ideally you're going to go to bonds eventually, but you could technically just be S&P 500 till you retire. So this one you will have to, you're supposed to modify. The older you get, you would like start taking some of the equity exposure and converting it to bond exposure. Now, I saw online a lot of people were talking, I think international, they talk about 25% international with this. The bond exposure, I saw a lot of places, I think Vanguard also said it's your age minus 20 would be the bond exposure in this. And then you'd fill in the rest of it with the US market percentage. So it gives you, so this gives you, which is nice because this isn't like the target fund where it's like whatever the target, the professionals that run the target date fund, they set those allocations. You have no say in it. Set it, and it is what it is. This allows you to make your own decisions to some degree if you care to. So that's something positive. Advantages of this type of allocation for your retirement: you basically investing in everything, right? You're getting exposure to the world's stock markets. You're getting exposure to the U.S. debt market. So very diversified. Contains every style and investment, unless you're like me and you can't get the U.S. market fund. Very low cost. These funds usually are very low cost. If you have them, which I'll show you in a second. I don't have the full options for this. Tax efficient, yeah, because you're not going to be swapping. It's in it's in your 401k anyways. You have no active management of any type. These are just buying everything for the most part. Style drift would imply the managers make decisions that can get away from what's in the prospectus. There's pretty much minimal risk of that here. They're just buying everything. Overlap, you're not going to have overlap. These are 3 very different types of assets. So minimal overlap. There's almost no turnover. Avoids front running. Rebalance. Basically, your rebalance is just going to be taking the U.S. equity portion and dialing it towards the bond portion as you get older. Ideally, if I was going to do this, that's what I would do. I would probably set my international exposure at like 20%. I would set, 20% initially bond exposure, and I'd start turning the dial as I get older of taking away from the U.S. Equity exposure. But I've seen a few different ways people talk about it online. Apparently, lazy portfolio ETF says this is very high risk, but that's just because it's ideally when you start, if it's like 60-20-20, that's 80% equity exposure, which they can consider high risk. So I don't agree. I'll show this in other charts. So this one is giving you international exposure to and you can adjust the international exposure, unlike the target date fund. And there's times when the international performs well, and so does the US. So this will represent all those time periods, unlike the S&P only option. So if we look here, we'll just do a simple back test from 2000. So usually I go from the Great Recession. Here we'll go from .com to today, 100,000, no rebalance. So we do 100% US market, and then we do an initial three portfolio, which I see like 60% US, 20% international, 20% bond. So you can see, obviously, like we said in the S&P 500 only portfolio, you're so far the US market has performed exceptionally the last 20 something years. Does that keep up forever? Maybe not. So that's the risk you take. But you will notice the US one is more volatile, right? The US only, that's not the three portfolios, it's more volatile, higher Sharpe ratio. And you can look, the worst year is worse and the best years are better. So bigger drawdown, I think they call it, between on the US only one. So basically, you can look, here's the drawdown. So you can see the peak to trough of the US only is more than the three portfolio version. So I would say how risk, it's the same question as a lot of these. How much risk are you willing to take on, and how much volatility are you accepting in your retirement portfolio? You should consider your financial situation. Do you have a secure job? Do you have a pension? Do you have other assets that you can draw from if things go bad in your life? So these are all decisions you are going to have to make. But this overall is a really solid way to put your 401k, I think. The guy that made this, I guess his name is Taylor Larimore. This was his like original allocations, which I think he must have been like retired, because I'd imagine this is like what this would probably be like what the three fund portfolio would look like when you're like at retirement. It would look something like this, 40-50% bonds at that point, right? So you want less volatility at retirement, because you can't, if you're drawing 4% out per year to live off of, you can't, you don't want high volatility, because then that could really affect your portfolio's performance over time. So if I was going to do this, so here's the dilemma with this. You might not be able to do this three portfolio with your choices at your job. So for me, if we go to large cap, so I don't have a total US option. I have this one, this equity option. That's the S&P 500. It's a BlackRock fund. So I can do that. I can do the international though. I have an ex-US international Fidelity option. I don't have a total bond option. You can see this one, this debt index unitized. This is a debt account. So it's a special instrument that they have at my, for my state. So it's a mix of corporate debt, government debt, treasuries, bank notes. So it's a mix of all sorts of debt instruments. So technically it is actively managed. I was looking at the page. It's a higher expense ratio also. It's like 0.4. So I don't have technically a bond option that's low fee and passively managed. So I technically can't really do a 3x, not the way they've told, like not the way it's designed. I basically can't do it. And I can look at my wife's options. She has the S&P 500. She doesn't have a US. She doesn't have a US total option. She does have. There is the Vanguard Total International, so she can do that part. But then same problem as me. She has this total return bond thing. This again is an actively managed bond fund that is not the total US, and it's a higher expense ratio. So she technically is the same boat as me. We both can't do this three fund the way it's been, thought out. We can do something close to it. So this could be a disadvantage. You might not be able to do the way this was designed to be. So that's one bad thing. So he's got a video also. I'll link. You can watch that. He has some good videos on this stuff. Optimized Portfolio, I think, is his channel. This isn't like normally what I talk about, but I'll explain probably in the last video. I might do a follow up, like what I do. It's like a modified target date fund, pretty much. I manage it myself. I actually just reallocated it yesterday or Friday. So this is like this, like he was talking about here, like the starting point of this, like when you're 20 something, you would probably start at like 60% US, 20% international, 20% bonds. And then over time you would lower this exposure and turn it into bond exposure as you get older. You could leave this till you're retired. Although, I mean, I don't know. The one thing to note So you're getting less volatility because this has more bond exposure earlier on than the target date funds. They don't have 20% when you're that far out from retirement. When you're 40, 45 years from retirement, the target date funds are like less than 10% bonds. So this gives you, it's actually a less volatile option than what they would give you. So, but you're getting basically every type of asset broadly diversified. Hopefully you can do it the way it was intended. You might not be able to, like I can't. So I think this is a great option though. This should perform in all different types of markets and situations that could come up over your career. Let's say 45 years from 20 to 40, 65. This three fund portfolio gives you exposure to basically everything that you'd want to. I don't think you need international debt exposure. I have never seen anything to show that that's worthwhile to invest in. And that's the only thing you're missing from here, basically. And I guess they don't have technically treasuries. You would not buy treasuries with this style. I suppose you could, but it's not really intended for that. So that's this portfolio. Yeah. So that's this option. Option number 3. I like this one. I like all of them. I mean, I don't think any of these are bad. So not bad. So if you can do this, I mean, I can't technically do it the way it's designed. So that's probably the biggest negative of the way I look at it. And I don't feel like I personally don't want the bond exposure as much as this has it. That's my preference because of my situation, which you could be different. So, but good option. And we'll move on to the next one after the next one will be, I think, 60/40. So, all right. Thank you for watching.